Our next guest says the Fed's higher for longer messaging will remain difficult for the markets to digest, but he does see reason for optimism on the horizon. Joining us this morning, BMO Wealth Management CIO Young-Yu Ma. Young-Yu, it's great to have you back. So people are starting to assemble lists of reasons to get more constructive: buybacks, positive earnings, seasonality. But how much can really be done until the rate picture moves out of the way?
Well, I think there are a number of headwinds that are still very meaningful. The interest rates, the Fed messaging is very difficult still, that hawkish messaging, and even the potential for another rate increase. And not to mention longer-term rates are rising. All of those together present a substantial headwind at a time when you have student loan payments being resumed, some consumer strain starting to show up in terms of delinquencies and debt. So I think this is just going to take a while to work through. And those reasons to be bullish, they may be present, but they're not going to sort of carry the day for a while. So I think it's going to be a longer process.
What about the argument that you really have laid a more fertile groundwork for earnings to impress, given the drawdown so far?
Well, I think that's okay. But on the flip side, there's a risk of profit margin compression. I think, yes, we've had a pullback in the indices. There's not as much optimism in terms of the outlook going forward, but I think the risk is also to profit margins ahead. So it's a double-sided coin here, and I think it just takes some time to play out. There are some stabilizing factors. I think that the labor market will continue to be relatively stable going forward, and that will at least stabilize consumer spending, and eventually corporations will kick back into gear with corporate spending as well. But the process is going to be a few quarters. It's not going to be a few months.
Should you stick with energy? Because I'm looking at the month-to-date returns, 4% higher, the only sector that's higher. For the quarter, up 13%, best performing sector. Is that a good place to be? Or do you have to think that oil prices will continue to rise here, even in the face of economic headwinds?
Well, energy is a good diversifier here. We like it as a diversifier in portfolios. We wouldn't go all in on energy here, but to the extent that we have rising oil prices, geopolitical tensions, supply constraints, we think it's a nice spot in a portfolio that adds stability. And we also like infrastructure and industrials here. We think they're poised to continue to perform well. There's a lot of spending going into U.S. infrastructure. We think there's a very long runway ahead of that. Those are the two areas that we think can still remain stable, even along this process of a soft landing playing out longer.
Even though those are both very cyclical areas, and I know you're worried about the consumer.
They are cyclical, but spending that's where the money's flowing. The old adage, follow the money, I think applies here. We have a tremendous amount of money going into U.S. infrastructure. We have rising oil prices, and there's going to be continued spending in that area as well. Continued profits just because of the prices at the pump. So I think those areas will continue to be stable going forward here.
You mentioned student loans, and we obviously saw a conference board yesterday, 4-month low. A lot of concerns about delinquencies and credit cards and the rundown of excess savings. But you still got jobless claims at 201. I mean, doesn't that have to break before you can really call a verdict on the consumer going forward?
That's right. We do think the consumer will remain stable. When you get those initial unemployment claims in the low 200,000s, that just speaks to strength underlying the labor market. And at the end of the day, if people have jobs and they feel stable in their jobs, they'll continue to spend. They might pull back a little bit, but it doesn't create an environment where there's a likelihood of downward momentum in spending overall. So we do think there's stability, but there are strains starting to show. And until some of those strains get worked through, which we think will take a few quarters, it's hard to see a catalyst for a sharp upturn either in the economy or in the markets.
The other interesting twist in this particular cycle is healthcare, which classic defensive sector, although these weight loss drugs have thrown models all out of whack about what kinds of health services we may potentially need generationally in the years ahead. I wonder how you think about that.
Yeah, that's always an interesting sector because there's also a risk of regulation and at least discussion about that in an election year. But it is a sector where there's innovation, and that's very important, right? Especially if you throw biotech in there as well, there's a lot of innovation going on there. So, it's an idiosyncratic sector. It's difficult to pigeonhole of when you should sort of overweight healthcare, but it is something that there's a lot of interesting developments, innovation going on.